All right. Good morning and welcome to a weekly edition of the Main Management Market Note for August 29th. We're recording this the day after Labor Day. So hopefully you are well rested and reentry has not been too rough into the end of the work week. We had a pretty solid data week last week. On the performance side, things were pretty mixed for the week. Year to date, they're still resoundingly positive. Healthcare is the only sector in the red. But the weekly performance was, I guess, more red than blue.
Mhm.
Just as kind of markets are digesting the PCE data, the kind of Fed path,
Mhm.
the legality of tariffs, the attempt to fire Cook. There were
There's
a
a
lot, a
lot of
lot of stuff to
headlines.
kind of
Yeah.
come into that week there that kind of created some chop in markets. But as you can see again, year to date, things are still up and to the right for the most part. Recession dashboard, not much change in August. September, I think that we'll have this will update this week. We update these as they come out, I guess, or as they update the columns as the data points come out. But I think this week, the non-farm payrolls are the big thing at the end of it.
Mhm.
I think we get productivity as well. But the non-farm payrolls are real the big piece to see
Yeah.
kind of where that might influence Fed policy. As far as the data from last week, the big piece was core PCE. So you're getting two sides of the Fed's mandate back-to-back weeks with core PCE. So that's the preferred inflation measure of the Fed, or the stated one at least.
Mhm.
It was up 0.27% month over month, in line with forecast. That's the biggest gain since Feb of 2025. Year over year ticked up to 2.88, rounding up to 2.9. That's also the fastest since February. The gain was kind of driven more by goods rather than services. Goods were up almost 1% month over month, while services slowed to just 0.1% month over month. And on a year over year basis, goods is up 1.7. February ticked down to 2.9. For goods, that's the slowest since February of 2021, which is kind of interesting there, despite the jump this month. But you've seen some really solid increases, and so it's kind of on an easier comparison, I
Mhm.
guess, rolling off, so to
The
speak.
the goods piece is interesting too, because obviously tariffs are something that's top of mind, and
Hmm.
those are, I think, exclusively affecting the goods side of things. But I think a lot of that's the offsetting where you've seen several headlines now. I know in several earnings reports, earnings calls, a lot of CEOs said that they haven't really pushed the tariff tariffs through, the tariff inflationary effects through to the
Hmm.
end goods that they're selling to consumers. There was a Goldman report that said something similar, uh, that most of the tariff effect is not being kind of pushed through yet.
Yep.
So it's a to be seen if that actually becomes
Yeah.
an effect on the PC or on the goods portion
Yeah.
specifically.
But again, since tariffs were announced back in February,
Yeah.
March, we're still kind of waiting for these to really show up in a big, meaningful
Hmm.
way. Because none of these readings have really been truly like outsized, and
Yeah.
and we still, as James just mentioned, haven't seen companies coming out and saying, "Hey, all right, we're pushing these through."
Yeah.
Like, sorry, consumers.
There's been like certain items within the PCE
Yeah.
or within CPI, these different inflation reports, PPI, that you can see the effects, but nothing kind of broad based.
Yeah. Yeah. And so this reading was kind of in line as
Hmm.
expected. And it, potentially raises the bar for rate cuts from the Fed, given that inflation is increasing or accelerating. We'll see what happens with non-farm payrolls on Friday. That will be certainly something that markets are very, very much
Hmm.
looking forward to. But as of now, markets are pricing in roughly an 87% chance of one 25 basis point cut in September.
Yeah, it feels like this report was pretty well forecasted by the CPI and
Hmm.
PPI. And we'll go a bit deeper into it, but the it seemed like overall it didn't really change anything for the Fed.
No, not
Um,
hugely. I think
it
I
was in
looked
line.
earlier last week, and the bar, or the chance of one cut was like 82 or 83%
Hmm.
earlier in the week, and up to 87.
Yeah.
So, markets are kind of, as you get closer, there's less uncertainty. And I
Hmm.
think, is it anything like above 60 or 70, basically
Historically, yeah.
historically is indicated and had been a correct predictor of what
Yep.
the Fed will do. So we'll see. That meeting's in a couple weeks here. On the income and spending side, this kind of surprised the upside a little bit.
Hmm.
Consumer spending accelerated to 0.5% month over month, fastest in a few months. Year over year slowed to 4.7. But again, if you look at, we're still kind of moderating from those massive COVID, distortions.
Hmm.
And that 4.7 is above the first couple of, or sorry, the prior average for the couple of years leading into March of 2020. So we're still running above pre-COVID levels. And it's kind of tariff uncertainty is abating a bit.
Hmm.
Again, as we said, retailers are not necessarily passing this through yet,
Yep.
so that could slow things down. But again, it's a good reminder that don't bet too hard against the American consumer. We like to spend money
Yeah,
like it's going out of style.
it's felt like there was really poor kind of economic results past couple months, and now you're seeing just a bit of a rebound on that, maybe forming some sort of bottom.
Hmm.
It's maybe too early to call that, but I saw a headline today that the economic surprise index was the highest in several months.
Yep.
So this, kind of reiterating that some of these reports are better than expected, which bucks the trend that we've seen.
Yeah, and it's good to see incomes accelerate as well, up 0.4% month over month. And
Yep.
that year-over-year figure is up 5, which is a solid gain. And again, continuing to outpace inflation, which means
Hmm.
real purchasing power for consumers. One thing within that income, that a lot of that is kind of government transfers. So it's Medicare, Medicaid, unemployment insurance. You saw some really big spikes in COVID when those stimulus checks went out.
Hmm.
But basically, a big piece, or not a big piece, but an important piece is the unemployment benefits, and those are declining. So there's been talk of, the claims are rising, they're muddling, continuing claims kind of continue to make cyclical highs, and seeing the unemployment benefits decline is good because that means fewer people are applying
Yep.
for unemployment insurance. And there was a distortion on that several months ago
Hmm.
that was around like the calculation for eligibility
Right.
that really skewed that, and seeing this kind of decline independent of that is nice.
Yep.
We got Q2, the second estimate of Q2 2025 US GDP. That was a surprise upward revision to 3.3 from 3.0 or 2.97 for 2 decimal places, which is the fastest since Q3 of 2023. Basically, all the components were revised higher. Inflation figures were revised down. And again, this is all stuff we've lived through. This
Hmm.
is 2 months in the rearview mirror now, but it's good to see those figures revised higher nonetheless. You got to start. You got to calculate it somehow. And
Yep.
it takes a while because GDP is a unwieldy figure at $20 trillion. Final sales were revised up by nearly 0.5% to 6.8. That's the biggest since Q2 of 2021. Private domestic investment was revised higher, but that's kind of the biggest drag at minus 13.8. That's that gold bar there, I think, if I can see that correctly. Yes. And as you can see, trade is still really the big driver in these. You saw the massive kind of net exports
Hmm.
drag in Q1, and that's been reversed in Q2. And here we kind of look at, this is looking through to core PCE for the quarterly basis. That was revised down to 2.47 from 2.54. Technically, if you do 1 decimal point, somebody would say this didn't change,
Yep.
but it depends on how you want to skew the data to fit your narrative. But one thing that's been good is on the right, we show gas and other energy spending as a share of total consumer
Hmm.
spending. And that's all the way down to it's under 2% now. So people are spending under 2% of total spending on, on energy and gas. And that's the smallest share since Q4 of 2020, which means, you basically have more wallet share free for other purchases. And this kind of goes up when gas prices go up. And
Yep.
that's something that consumers really respond kind of visibly to, is if
Hmm.
they go to the gas pump one week and it's $4 a gallon, and they go the
Hmm.
next week and it's $4.50, they start pulling dollars out of other spending areas to account for that difference, because it's very, very obvious. And even if you're not going to the gas station, you still see the prices every day you drive through there. Or drive past it. So
Hmm.
this is good to see, as that's been on a steady decline. And you can see that still hasn't been above its median in over a decade, which is pretty impressive. And I think that also speaks to kind of the energy independence and production that the U.S. has from an oil standpoint, which is good for energy security.
That reminds me of, and I don't know how related this is, but a lot of the data center kind of production or spending driving up electricity costs. I don't know if you've seen kind of the pieces on this, but there's certain counties, states, I know particularly on the East Coast, like I think Virginia is a big hotspot for it, where
Hmm.
data centers are using so much energy. And it's not gasoline, but it is electricity, and
Yeah,
that's actually driving up the electricity costs for the surrounding
consumers.
consumers
Yeah.
and the homes. And I don't know, that just this reminded me of that piece.
Yeah, I
Thought
haven't
that
seen
was
much on that yet, but that's interesting
yeah,
to consider, because it's the same power grid.
yep,
And if you've got
supply and demand.
yeah, and if you
Yeah.
have to increase your generation and like expand your capacity, that's going to get passed through to everybody. They're
Yep.
not just going to pick on the one data center that got built in the next neighborhood over to say, hey, you're going to cover the cost of increasing for this.
Yeah, I just wonder how that will show up in, obviously this is, a couple months delayed now, or lagged now, but I wonder how that will show up in these consumer spending
Yeah.
reports.
Well, I guess
Keep
we'll
an
wait
eye
and
on it.
see.
Yeah.
that those build outs will take a couple of years, so
Yep.
it might be kind of a prolonged dynamic.
Yep.
We also, in addition to Q2 GDP, we got corporate profits, which rebounded to 3.3 trillion after being down in Q1. They slowed to 4% year over year. That's the smallest rise since Q3 of 2023. Profit margins ticked down to 15.7, but remain considerably elevated to history. If you took out that kind of COVID spike, this is basically the highest level we've ever been at. So that's, and it's, sorry, going back to the 50s. So basically margins, and this kind of, is good because if you believe corporations that they haven't started passing through tariffs and that they're kind of eating them, and having them eat the tariffs and margins stay elevated is a good thing, because they, if they start getting margins squeezed by tariffs, then they're more likely to start passing them through. So if margins are staying stable, then they're less likely to pass through, I think, those tariff costs to consumers, which is good for everybody. Durable goods orders fell 2.8 month over month. That was better than forecast for a 4% drop. This is really driven by the volatile aircraft category. X transports were up 1.1. That's the best since September of 2024. Core capital goods, which is closely watched for business spending plans, rebounded and was up 1.1 as well. And kind of, this is a pretty solid report. You have to take out the volatile aircraft category because you get like one-time big orders. And I think this saw an unwind in like a Qatar Airlines order from Boeing or something. So it's really these like specific deals that drive the transports, which then drive the headline. So we like looking at the X transports and the core capital goods because it strips out that, kind of noise, so to speak. But on a year-over-year basis, X transports accelerated to 3.8 and core goods up to 4.1. Those are both the best since November of 22. So you're seeing kind of a solid uptrend here. Total durable goods slowed to 3.3, kind of going back to normal levels, as you can see on the right there, that blue line, some big spikes. But these things, the core ones are in a pretty solid accelerating uptrend on a year-over-year basis, which is good to see. And then, consumer sentiment, we get the Michigan Consumer Sentiment Monthly. They have come out with a prelim and then a final reading. The final August reading was revised down to 58.2 from 58.6. Expectations revised down to 55.9. Current economic conditions saw an upward revision to 61.7. You also saw inflation expectations revised lower, but they still moved higher relative to July. I think, I say this in the note, and it's also in our monthly roundup that I'm sending out. But this survey, and our CEO Kim, said this himself, where this looks kind and feels kind of broken with the way these numbers. And you look at the chart on the left there; those are the actual readings. Like, it's hard to believe that we haven't regained the 2015, 16, 17 numbers on a sentiment level. If you want to, if you were to say to somebody, "Hey, we're still stuck in 2010, 2011, like GFC aftermath levels,"
even below where we were in March, April of 2020.
Yeah,
like it felt like the entire world was
coming down around you.
Yeah, it was ending, and you were trapped in your home. It's kind of incredible to see where
people are
sentiment is relative to that.
This sentiment, this indicator, I think, and I don't know if it's the way they phrase the questions. I think a big part of it too, somebody pointed out, and we've touched on this before, is if you have somebody making phone calls, you as a human are less likely to be super pessimistic and kind of berate another human. Whereas if you're filling in a box in a text form on a website, you're gonna rant and rave all you want.
And I looked into that, and I think statistically they said, there's no difference, or no, there's a slight difference of like a point. I think it was 8-point difference between a phone call and an online survey. And they said, okay, but that's just a small thing, and the correlation is like 99% or whatever.
But 8 points, like I saw a regression on this, and it was 8. It's literally like 7.5 or 8 points structurally lower than it's been.
But even 8 points higher is still
not great.
Basically
Anyways, I think we point this out because markets kind of do digest it, and they do move a little bit on it. But we also, kind of say, hey, take it with a grain of salt with other readings and kind of look at the whole. You've seen the NFIB sentiment move a little bit higher. So kind of, and keep in mind it's consumers versus businesses can be.
You have to look across a bunch of different sentiment surveys because different populations, who they're surveying, how they ask the questions,
Different
methodology.
questions. Yeah, exactly.
So,
And then finally, we got we have a couple more. Sorry. We have the regional Fed manufacturing indices for August. Current, pretty mixed. Future, a little bit better. But basically, this is kind of just saying, hey, these things maybe look like they're trying to move higher on the
mhm,
whole. But again, this is the manufacturing sector is kind of challenging. Just muddling, kind of moving forward, chugging along, nothing too positive or negative here. And then on the home price indices, this is some hopefully maybe signs of coming relief, but you're seeing the S&P K Shiller 20 city home price index tick down for the fourth month in a row. It's up 2.1 year over year, which is the smallest since July of 2023. The FHFA house price index, which is Fannie and Freddie guaranteed mortgages,
mhm.
declined for the third month in a row. That's its longest streak since early 2011, and it's now up 2.6% year over year, which is the smallest since April of 2012. So home prices on a month over month basis for the last couple of months here have started to tick lower. And hopefully that's kind of a sign that, maybe sellers are realizing, hey, I'm not getting any buyers coming to
Yep,
play with these
yep,
astronomical prices.
yep,
And if I want to sell, I might have to make a few concessions
yep,
here on the price. So hopefully what this means is you maybe get a boost to affordability, which helps unlock the housing market. If you get a rate cut and rates respond in kind and come down a bit, I think we were talking on our morning call where there's the home builders are kind of saying, hey, if you see a 5.9 under a 6, that's kind of a key level. And again, you think about how people respond going from 7.1 to 6.9,
mhm,
from 6.1 to 5.9, those 1% increments
yep,
definitely weigh on people's minds. So if you were to get something in 5.9 below 6, that seems like it could certainly help. And if you get the prices to continue to move lower, maybe you can get some sort of unlocking in this because inventories are building, prices still remain high, and there's no sign of relief as of
yeah,
now, other than these indices starting to decline. So
yeah,
we shall see. Kind of so in summary, that was a lot, but core PCE basically in line, up 2.9 year over year. GDP revised higher, nice positive revision there. Durable goods saw solid gains outside of the volatile transport sector. Michigan consumer sentiment just continues to, but it's maybe broken, maybe not. Regional Fed manufacturing indices were kind of mixed for both current and future, and the house price indices are starting to show a weakening trend, which hopefully can boost affordability. Uh, this week, first week of September, so we're almost at the end of Q3, which is
yeah,
kind of hard to believe. But we get the PMIs, we get JOLTS, the job openings and labor turnover survey ahead of Friday's non-farm payrolls, and we get the trade balance Thursday. So that'll be some import and export data that people are looking at as we move into the 2 weeks until the Fed meeting, I
yep.
think, roughly.
Middle of September.
Yeah,
Yep.
middle of September. So thank you for joining us. That was a long one, but there was a lot to cover, and we hope you have a great week.
Thank you.
Thank you.